with those 20 developed market countries. The 4% rule, it was really an artifact of US data. It also worked in Canadian data, but it really didn't work in any of the other data sets. The problem with something like the 4% rule in terms of liquidity is if I believe in the 4% rule, I have $1 million in a brokerage account and I want to spend $40,000 a year. Technically, I have $1 million of liquidity, but in a true sense, I don't have any liquidity. So that sequence of returns risk, that's if you get poor market returns in your early retirement years, even if the market subsequently recovers, your portfolio doesn't get to recover. And you're kind of locking yourself into a lower sustainable spending level. The first 5 to 10 years of retirement are really important. I've estimated that if you had a 30-year long retirement, the market returns in the first 10 years will explain about 80% of your retirement outcome.
So Matt, today we are operating in your sweet spot, I think, with our topic.
Well, you know that I will never pass an opportunity to talk about the knowledge of Wade Pfau. It's just this is a happy place for me, Jack. I appreciate we're doing this.
So we're going to talk about retirement planning. We're going to talk about the 4% rule. We're going to definitely lean towards the investing side because we know our audience likes to hear about investing things. And, basically I'm just going to get a beer here and I'm going to sit back and enjoy this because this is really going to be Matt Ziegler in his prime. And just for the record, though, it is 11 o'clock on a Thursday, so I probably will not actually have a beer, but I will have a metaphorical beer here while Matt schools all of us and how this all works.
You're going to drink that big gulp full of scotch, right? That's where you're going, straight for that one.
Exactly, yeah. I mean, you might have to seek help, some third person pops into Riverside here to have an intervention here with the audience as to what Jack's doing at 11 o'clock on Thursday.
We'll bring the doctors in, but bottom line, the great thing about Wade Pfau's work is he takes the quantitative, the rigorous, analytical, academic stuff, and then he applies it in ways that you can actually apply to the rest of life. Like we use it in the financial planning world constantly, incessantly. It's in every corner of what we do. And it's because there's so much analytical rigor behind the scenes that informs the not one view to take. He's got lots of frameworks to say, here's all the math, but then here's all the different ways this might apply, which is why his work is so brilliant.
Yeah, and for me as an investing guy, there's so many investing implications of what he has to say. So I think people who are into investing are really going to enjoy this. The one downside for me is, as you know, I need a bearish macro cover for our episodes, and I just don't know what I'm doing here. I mean, is it going to be like your retirement will be destroyed or something, or I'm not really sure which direction I'm going to go.
Yeah, maybe are we all going to die?
I'm sure Wade will really appreciate his work being highlighted in that
with his face and a little calculator or something. We'll get it.
The 4% rule will destroy your life or something. I got to come up with something, but I'll work on it after. We'll come up with something. You and I will work behind the scenes, and the viewers can see what we ended up coming up with. But to get started here, to get in the clips of Wade, he has this great framework, and I feel like he's kind of seeing your 3 C's and raising you here because he's got his 4 L's. But we'll talk about whose is better in a second here. But first, here's Wade talking about the 4 L's.
Those 4 L's, I view those as the financial goals of retirement. Lifestyle and longevity are about the retirement budget. And it's back to that point. If you can make a distinction between essential expenses and more discretionary expenses, longevity is the essential expense. Lifestyle is the discretionary expense. Some people can't make that distinction, and so maybe you'd really just talk about lifestyle and forget about the longevity. But both are related to your budget. Legacy is pretty self-explanatory. It's just your legacy goals, what you'd like to leave behind at the end. And then liquidity, I view as assets not earmarked for other purposes that can be a true source of liquidity for the unexpected. The problem with something like the 4% rule in terms of liquidity is if I believe in the 4% rule, I have $1 million in a brokerage account and I want to spend $40,000 a year. Technically, I have $1 million of liquidity, but in a true sense, I don't have any liquidity. That entire $1 million is earmarked to meet that $40,000 spending goal. And if I use it on something else, I'm jeopardizing the ability to meet my future budget. So I think of liquidity as assets that haven't been earmarked for something else, that are available for whatever you want to use them for outside of your longevity, lifestyle, and legacy. And then it's just a matter of positioning your assets in terms of earmarking them to your goals, the liabilities associated with those goals, so that you've got expenses. Your longevity, those essential expenses, cover those with Social Security, with any pensions. And if there's a gap, consider filling that with an annuity, or if you're comfortable with investments only, you'd be drawing from the investment portfolio to do that as well. And then for the diversified portfolio, I like to associate that more with the lifestyle, discretionary spending, as well as legacy goals. And then reserves, depending on how everything's structured, that could be anything from like a long-term care insurance or your home equity, just family and community support, the types of things available. And it could even be part of the portfolio that's not really needed for other purposes. But what's available to help cover the unexpected in retirement in terms of unexpected expenses that haven't been budgeted elsewhere in the financial plan. So I don't necessarily use the term bucket for those categories, but you could certainly think about it that way, that these are the 4 general areas you want to try to earmark assets to cover those expenses.
Yeah, so we've got lifestyle, we've got longevity, we've got liquidity, we've got legacy. And I think for me, like as somebody outside of this, these are really good. I mean, some of it is, if you think about like, what do I need to spend? What are my discretionary expenses? What do I want to leave to the future? You could probably remind me on liquidity, but these are a good framework in terms of thinking about like the key buckets here, I think.
Absolutely. And remember that what he's doing is he's giving us these 4 L's in terms of guiding the retirement planning conversation. So this doesn't really apply in the same way to pre-retirement planning of figuring out how I'm going to buy that house or whatever else. This is specifically for, I've worked a period of time, now I'm making a decision to no longer work and now live off of assets or whatever else. So you mentioned the 3 C's. That's my calendar, cash flow, and your crap, which is basically what are the dates? What's the life? What's the stuff that's happening on the calendar? What's the money that's going in and out? That's the cash flows. It produces a surplus or a deficit. And then what's the crap? What do I own? What do I owe? AKA the balance sheet. And anything that's a surplus or a deficit in the cash flow statement turns into either an asset or liability on the balance sheet as we work our time across the calendar. What Wade does here is basically dive into the why, which fits as bookends around that calendar, cash flow, balance sheet conversation. So he starts to map out, what do we think about with our risks of longevity? Live too long, die too soon? What do we think about the risks to our lifestyle, the cash flow? What's the minimum amount we need to get at? What do I think about legacy? If I'm not going to consume it all, what's the gift that's left over at the end? When I think about liquidity, what are those key risks? And we're going to get into sequence risk and all the other stuff too, as I'm taking stuff off of the balance sheet where I might hit a bottleneck or I might not be able to do the thing in a given period of time. And how much am I comfortable with that or not? So this is Wade's way of asking the why question without just turning it into an emotional intelligence question.
So before I respond to that, do you feel pressure to have a 4th C now because there's 4 L's, like, or maybe a 5th C to raise him? Like, do you feel like you got to change the framework?
I'm not going to fight Wade over this one, but I think the difference here is I don't feel the pressure because he's solving specifically for retirement. And when I talk about my 3 C's, which I usually tone down, it's usually CCBS in the more formal setting because people apparently don't like when you refer to their assets and liabilities as their crap, which I don't understand. Looks like a bunch of crap.
I can't imagine why they would think that.
I don't know. Like, call the SEC. Let's see what they think about balance sheets. And if we could
do you use the crap in the planning meetings, or do you go a different direction?
I read it by
Depends
the
on who it is,
across
maybe?
the table. The person across the table. If you look like deer in headlights at the mention of an actuarial table, let's refer to it. This is your crap. It's in the junk drawer. You don't understand what's here. Call it for what it is. But if you need to hear it as your balance sheet, I'll call it that. But I think in the context of retirement planning, this is a great framework to use. As soon as you start to zoom out either across generations or earlier stages of life, there's some ways we can loosen up this language, and that's really what I'm seeking to do.
And one thing I'll say for both yours and his is these frameworks are really, really helpful with stuff like this. Like something you can remember that kind of categorizes the way you should be thinking about things. It can be really helpful, not just for like a quant guy, but like me, but for anybody. If you hear something like this in a meeting, it's something that resonates with you. Like ever since I heard this 4 L's, like I've thought about it a bunch of times in terms of my own planning and stuff. So I think these are really useful.
Yeah, you need frameworks. Just like you need, even if price to book is not the one that you're going to use, that tells you now how to categorically think about something, right?
Yeah, no, that's absolutely right. Yeah, you need these frameworks, and we use them in quant investing. We use them everywhere. It's just anything that can help you in terms of categorizing things and remembering the right things to do, and all that's really helpful. So this next step, we're going to get into something that everybody hears about when they hear about retirement planning. And I'll have you maybe define it a little bit after we do the clip. But this is Wade talking about the 4% rule. But this idea that the 4% rule was established, on US data and it may not work as well everywhere else.
And that was really my first study in financial planning. Earlier in my career, I was more of a traditional economist, and studying for the CFA exam. That's where I learned about the 4% rule. With other research I was doing, I had access to the global returns data set that's now available through Morningstar. It looks at 20 different, I think it's still 20 developed market countries going back to 1900. So I was just curious if Bill Bengen had been Italian instead of American, or whatever the case may be. Did the 4% rule work with other countries' financial market data? And instead of assuming US stocks and bonds, what if you use Canadian stocks and bonds or Portugal stocks and bonds? And this is still developed market countries, so it doesn't include, if you go back to 1900 and ask what are going to be the leading countries in the 20th century, maybe Argentina, Russia, China, different countries that ultimately had financial market collapses at some time in the 20th century and weren't even part of the data set. But with those 20 developed market countries, the 4% rule, it was really an artifact of US data. It also worked in Canadian data, but it really didn't work in any of the other data sets. And it's partly like if you lost a world war and experienced hyperinflation, Japan after World War II, Italy, Austria, Germany around World War I, sometimes World War II, you got very low withdrawal rate. But that's not the whole story. If you look at a country like Australia, it's actually the one country that had a higher average stock return than the US and also less volatility and really great performing financial markets. But nonetheless, their 4% rule became 3% during the same sort of like late 60s, early 70s stagflation era. I think it's just sort of one of the characteristics of US data is we've had downturns, but markets usually recovered pretty quickly on a relative basis. Whenever we call it 2008 financial crisis, well, by the end of 2009, things are on the road to recovery. The 2020 spring with COVID, dramatic collapse that recovered quite quickly. And if it recovers quick enough, you don't really get locked into the sequence of returns risk because you're not taking that many distributions at a loss. And so the 4% rule survives in the US, but it really didn't work as well with other countries. And if you put all the international data together, the 4% rule worked only about 2/3 of the time historically, rather than like the 100% type number you'd get with just US historical data.
So first, before we get into that, I'm just very surprised, and I think the viewers are surprised as well. Like, no comments on the wall behind him. Nothing yet. I mean, I think we've got some paintings in one of them. We've got like some of his books like on the diagonal. Like, are there any thoughts around that?
I think it's a practiced wall decision. I want to give Wade a lot of credit. I think he's thought about this. He's thought about what appears behind him. He wants it to be very neutral, very safe, very academic. So I'm giving him the credit on he's not giving me a lot of like thought-provoking distraction, which doesn't surprise me. This is the way his work all comes across, right?
Yeah. So maybe again, what you said before, like the wall tells you a lot about the person.
Yeah, the wall tells you a lot about a person, and you can tell that Wade does a fair amount of presentations by the looks of the various walls that we have in these clips.
And I did have a podcast pitch for you. I was thinking the wall behind you with Matt Ziegler, where basically you just have to get into what it says about their life, whatever it is you happen to see on the wall behind them when they pop on.
You don't want to know how excited I am right now for proposal.
You're actually thinking about you could probably do this.
Like that would be phenomenal. And even get like the random people like that are doing the call from in the hotel room or whatever else. Or you know how this goes. How many times have we started something with somebody and you hear about whatever crazy thing is happening? They're like, well, the construction company shut off the power to my apartment. So now I'm in this other place recording with you right now. Hopefully the power won't go out. And you're like, well, here we go. 1, 2.
And of course, I like this concept until you look behind me and you're like, tells me something about the emptiness of my soul or something, that there's absolutely nothing behind me up on the wall. So, I probably don't want to be the first guest.
You're in your quantitative value cathedral. That's where you are. That's in my mind.
That is pretty much it. So anyway, on to the 4% rule. Maybe before we talk about where it works and why it doesn't work, can you talk a little bit about maybe just quickly what it is?
I think the easiest way to think about the 4% rule without getting into the Bengen study is just think about it in pure piggy bank terms. Remember, this is a rule where people are talking about safe withdrawal rates in retirement. And the piggy bank rule basically says, if I have $100 inside of my piggy bank and I'm going to take out 4%, $4 a year fixed that whole time, I got 25 years before the piggy bank's out of money. Like, that simple. That's all that it is. And this idea of 25 years, if you take the average retirement age and you say somebody's going to be in their mid to late 60s or maybe even 70 years old, that's typically going to get you past human life expectancy. And the 4% rule basically says if you, instead of a piggy bank, you have that invested in a moderately diversified portfolio, basic stuff with inflation, most of the time that 4% rule gets you past that time horizon adjusted for inflation and everything else. What do you think of my piggy bank assessment first and foremost?
No, I think it's excellent. And so just the details on this, just really quickly, not getting in the whole banging study. It was something like 90% plus of the time you were fine. And I think the portfolio was 50-50 stocks bonds. I might be wrong on that. Is that right?
That sounds right. It was a mix of stocks and bonds, basically a moderate allocation. And again, it survives the distributions in a pro rata sense over that period of the time. Most of the time in the historical study, and then again in the updated study. We have a whole episode on this somewhere if you really want to torture yourself.
Yeah, we have all kinds of detail about you and I telling probably the same exact jokes we told in this one and then rambling on about the 4% rule. But anyway, getting into what he said in the clip, it is very interesting because one of the things you learn as a quant is like the data set you're using is really important. And so all this work was done on the US data set. And so an obvious question, and Wade did the work on this, is what if I apply this to other countries? And obviously, like the Russias of the world, it's not going to work. But like in other places, one of the things he found is there were very few places where this held up. And so that's just something, it's not something to be completely panicked about, but it's something to understand. Obviously, we've had a very strong stock market in the US, a lot of that justified by what goes on in the US. But if I'm in another country and I take the US data and I'm like, I'm going to use the 4% rule, it may not work out for me. But also for those of us in the US, if history doesn't repeat itself, maybe that number is less than 90% in terms of how much this works. So I just think it was a great example. I put it in here because it's a great example of the dangers of data and how you look at data from the perspective of a quant in terms of how you evaluate these things.
Yeah. And I think I have this system that I always use with people. I call it my rules of thumb versus my rules of big toe. Have we talked about this before?
I think you have, yeah.
Okay.
The listeners want to hear it though.
The rules of thumb are the things other people tell you. So the 4% rule is a rule of thumb. If I take this and then go over to see my brother in France and apply the same 4% rule on retirement, it might not be the same. I might need a different piggy bank to get me through there. And the rules of thumb, things other people tell us, are differentiated from my rules of big toe, which are things where I've stubbed my toe on the wall or the nightstand in the middle of the night or whatever it may be, and I've learned some harsh lesson personally, which also means I'm going to over-index to my unique personal experience with that, with whatever happened to me. So rules of thumb are really useful to give us an idea, but our rules of big toe are the lessons that we've learned and internalized for ourselves. In a case like this, where we can't know the forward-looking data, we got to think about what that piggy bank is that we're constructing, why we think it's safe in the domain we expect to use it. So if that's retirement, you're going to look at the country you're in and you're going to say, does this actually make sense as a sensible, logical strategy? Will this get me past inflation? Will this get me past my average period of like drawdown and recovery on my equity side? Are my bonds safe? Are they not? You're going to look at all those factors and ask, not just what are the rules of thumb only, not just what are my rules of big toe only. You got to combine them and figure out what you're going to do that makes the most sense for you.
Yeah, it almost should be called, I don't know if the 4% suggestion is a good rule for you. I mean, people aren't going to like it if you call it that, but that's what it is. I mean, you're not starting your first planning meeting with somebody on their day of their retirement and being like, I've written your check for 4% for the next year. Come back in a year when I will look at the CPI and I will adjust it. Like things happen in people's lives. Like nobody's withdrawing exactly 4% out of their portfolio. It's a guide basically to help you figure out what a reasonable withdrawal starting point might be for some people. And then you can kind of work off of that. And those guides are helpful. But when you start using the word rule around them, it becomes a little more challenging.
Yeah. And I have to imagine this is the kind of thing that like Wade Pfau probably wants to jump out of a window when it comes up, right? Because there's so much nuance. There's so much richness to this question. Again, good starting point if you remember nothing but the piggy bank principle of just like how many years can I withdraw this with no changes. That's probably the core idea that you just need in your head for thinking about where and when and where this applies.
So this next concept is the risk we're sort of dealing with in retirement that all of this is built around, and this idea of sequence risk. And, some people hear sequence risk and they think like some complicated thing, but it's really not that complicated. So here's Wade talking about sequence risk.
Yeah, so sequence risk, it's something that can exist pre-retirement, but it really becomes an issue post-retirement when you're taking distributions. And it's what Bill Bengen really created the 4% rule to help people understand. You can't just plug an average return into a spreadsheet and assume, say, historically the S&P 500's performed 7% after inflation. I can't just plug that into the spreadsheet and assume I'll get a 7% return every year. Sometimes markets go up, sometimes they go down. And when they go down, I'm having to fund a spending goal. So I'm having to take a bigger percentage of what's left from my portfolio to meet my expenses for that year. And then even if the market recovers, we believe in stocks for the long run, that if the markets are down, they eventually come back up and balance out, and you get a reasonable investment return over time. But when you're having to sell from a declining portfolio, your portfolio doesn't get to enjoy the recovery that the overall markets might enjoy. And so that sequence of returns risk, that's if you get poor market returns in your early retirement years, even if the market subsequently recovers, your portfolio doesn't get to recover. And you're kind of locking yourself into a lower sustainable spending level than might be implied by the average market returns over your retirement. You're really being impacted by those early retirement years in a disproportionate way.
Have you done any research as to what the period where you really need to worry about sequence risk is? I mean, obviously when you're retiring, you do, but is it like something like 5 years before and 5 years after, or where the period where that's the biggest risk is?
So sequence risk, it's triggered by having cash flows. If you just invest a lump sum, there's no sequence risk. You always have the same account balance at the end of the time horizon. But if you're saving every year and then you're spending in retirement, what I find, it's really around the retirement date when you're most vulnerable, say the 5 years before retirement. And then when you switch from adding new savings to taking distributions, that really spikes the importance of those returns. So that the first year of retirement is the most important market return of your lifetime. The first 5 to 10 years of retirement are really important. I've estimated that if you had a 30-year long retirement, the market returns in the first 10 years will explain about 80% of your retirement outcome. So the last 5 or so years before retirement, and then the first 5 to 10 years of retirement, and especially the first 5 years of retirement are by far the most important market returns somebody's going to have to deal with a lifetime financial plan where they're saving over a very long time horizon.
I'm wondering what this means for construction of retirement portfolios. So there's this common belief people have that, on the date you retire, you have the longest time horizon, so you have the riskiest portfolio, and then as you get older, you move to the less risky portfolio. But this would seem to suggest the opposite of that. Is that right?
In a way it does. And there's a few different ways you can look at portfolio construction in retirement. But one of those, I did some work with Michael Kitces where we talked about the rising equity glide path, that we kind of agree with the idea about target date funds pre-retirement, where the whole idea when you're young, you have a higher stock allocation. As you get closer to retirement, you take off some of that risk. But then where target date funds don't really get into too much details, what do you do after retirement? And they tend to either keep you at a low stock allocation or even getting lower over time as well. Like you were saying, that may continue to lower your stock allocation post-retirement date. But we think in terms of a risk management strategy, actually it's kind of the inverse of when sequence risk. You have kind of a U-shaped lifetime stock allocation. You have the lowest stock allocation at retirement, and then it's the same pre-retirement. When you're young, higher stocks, lowest at retirement. But then you can gradually start increasing your stock allocation again post-retirement as a risk management technique to protect you from really what's been the worst case scenarios, which is you get a bad sequence of market returns early in retirement and eventually markets recover. And so that kind of rising equity glide path would help manage the risk associated with that. It does create some behavioral concerns about getting more aggressive as you get older, but that's just more understanding the quantification behind it all, that you're helping to manage that risk around the retirement date by using a U-shaped lifetime stock allocation glide path.
So yeah, this is a really simple, the concept is really, really simple, which is basically if I'm pulling money, think about 2008. If I retire, in October of 2008, the stock market goes way down, I'm pulling money out of my investments, that money I pulled out can't compound. And so therefore, the order of my returns in retirement matters a lot. If I retire in March of 2009 at the market bottom, I'm in really, really good shape. That's basically what it is, right? I mean, it's just a simple thing that when you're pulling money out, the order of returns matters. And also for people who are young, when you're putting money in, the order of returns matters in the opposite direction. So I think that's a good summary of it.
I think that's a great summary of it. And much like we were just saying about the 4% rule, beware people who come toting this stuff at you, right? Like this is just a rule of thumb. So you got to remember that like all averages are not created equal. It's that old case of the math formula where basically you can double your money in year one, but then if you lose 50% in the second year, you go, okay, on average, I just made positive 25%. But in reality, the geometric average, I didn't make any money. I gained it, I doubled, but then when I got cut in half, I went right back to where I started. These things are ways that numbers are presented to us. Sometimes they're confusing. There's different ways to look at them. You have to look at them from multiple angles. And that's just a part of the harsh reality, like the 4% rule, where don't just accept this stuff as gospel. The other example I love here comes from Luca Delana. And I know ergodicity and non-ergodicity is your favorite word ever, right, Jack? You love that stuff.
I do love that word. I'm sure the viewers love it too.
Oh, absolutely. Who could not?
There's my YouTube cover right there, right? Some word that nobody recognizes. That's exactly what I should go with.
Hey, so the Luca version, the Luca story that he always tells is the skier story. And he's like, I have a cousin who's a really good skier and there's a 20% chance of him winning, but there's a 20% chance of him breaking a leg. So if he's got 10 races in front of him, how many races do I expect him to win? And the simple math is basically like, well, 2 races, a 20% chance of winning, it should be 2 races. But when you apply the actual math to it, you go, it's actually 0.71. It's less than 1 race on average that he's supposed to win. And the reason is if he breaks that leg in race 1, he doesn't get to race like 9 through 10. If he breaks the leg in race 3, he doesn't get to race 4 through 10. And it's understanding your sequence risk that your average result may not match your experience as you move through it. And if you get knocked out, it changes the math on everything. That failure rate becomes really, really, really important. What do you think?
Yeah, well, when Cliff Asness came on, he said something along the lines of a negative 100% return is tough to recover from, barring like whatever, declaring bankruptcy and refinding whatever it is you could do beyond that. But it's the same idea. The other thing I think is a logical flow from this is this idea that a lot of people think, all right, I'm going to withdraw 4% from my portfolio. The stock market's going to give me 10 over time. Why don't I just invest all in the stock market? And this is the reason, is because the order of the returns matters. And yes, there's a bunch of scenarios where you can do that and you end up great. Like I said, investing at the market bottom in 2009, if you invested 100% in stocks, you would be fine for the rest of your career. You would get through because you would make so much at the beginning. You'd be okay to get through the other bear markets. You'd maintain the 4% withdrawal rate. But on the opposite side of that, October 2008 or whatever, it's a totally different thing. And so that's basically the reality of the situation. So that's why investing in the highest return assets is not always the right thing to do in retirement. And most of the time, it's not the right thing to do in retirement. And that kind of gets to that other thing he talked about at the end, which is this reverse glide path, which maybe you can explain. But a lot of people believe when I retire, I should be very heavily in equities and I should come down the glide path as I get older. And in reality, a lot of times the opposite is true.
The biggest thing you're trying to solve for here, and this goes back to however you think about converting your balance sheet into cash flow assets across your calendar, is understanding what's that minimum lifestyle that I need to solve for? And how do I make that as safe as possible? And one of the ways I make that as safe as possible is once I have an allocation to bonds or cash or whatever is going to convert into that cash flow, hedging my longevity risk requires long-term assets. It might require more stocks. So I might be consuming and draining down my bonds or my cash, but actually staying long invested in stocks in greater portion as I spend down those safer assets to hedge my longevity risk over time. This is where it's just, you need a strategy to think about what you're doing here. And also the question of, if my goal is consumption, then I want to keep converting those, stocks into bonds or cash so I can consume them. If my emphasis is on the gift, then once I solve for that basic first level of my essential spending expenses, then I want to maximize those returns because I'm investing beyond my lifetime in that theory. So you need those categories though. You need this construct or else you can't do this.
So getting to the next one, this kind of gets a little more into the real world because like I said before, most people are not following a strategy where they withdraw 4% and adjust it for inflation for the rest of their lives. In the real world, we're using a lot of variable withdrawal strategies. So here's Wade talking about some of those.
The one end of the spectrum, not variable. It's what we've been talking about already. How the 4% rule, I would just call a constant amount type strategy or constant inflation adjusted spending where there is no variation based on portfolio performance. Now at the other extreme, you could call it a constant percentage or a variable withdrawal rate. If I took 4% of what's left each year, that's not what the 4% rule is. But if I simply said, okay, each year, January 1st, what's 4% of what's left in my portfolio? That's my spending for the year. that would be a constant percentage strategy. That's going to lead to quite variable spending. There's actually no sequence of returns risk with that strategy, surprisingly. So that's really the other extreme, where you could, if 4% is what you'd use with constant amounts, you might be able to get away with 8% variable rate, where you're not necessarily going to dip much below where 4% would have ever gotten you with the constant amounts. That'd be the other extreme. And then all the other variable spending strategies out there are some sort of compromise. The value of constant amounts is you have a pretty good sense of what your spending is going to be in the future. The value of constant percentage is you're going to fluctuate your spending to help manage sequence of returns risk and hopefully get a higher amount of average spending. So any sort of variable strategy beside that is how can we get some sort of balance where we're going to have some fluctuations for spending, but not too much fluctuations. And there's a lot of different strategies that are out there that usually different financial advisors have offered. One of my favorites is just where Bill Bengen, in one of his early articles, he talked about a floor and ceiling rule, where you use a constant percentage of what's left, but you have a hard dollar ceiling and a hard dollar floor that you won't go outside. So if I'm going to spend 5% of what's left every year, but if that number ends up being more than $80,000, or if that number ended up being less than $40,000, this is an example, I'll then stick to that ceiling or floor until the 5% of what's left gets me back somewhere in between. So I'd have fluctuating spending inside of a band. That can do a lot to help manage sequence of returns risk and still give you a good sense of what the dynamics are for spending. You can still have failure with that strategy because that hard floor that you build in ultimately could cause you to deplete your investments. But I think that's a good example. Probably the most famous variable decision rules are the ones developed by Jonathan Guyton and William Klinger. And they're complicated. There's like different variations of them. There's 4 possible different rules. But they're also looking at, they have a prosperity rule about basically when your current withdrawal rate is getting low because the portfolio is growing, let's kick your spending up 10%. They have a portfolio or capital preservation rule that, well, if it looks like your portfolio is losing and so the current distribution rate is getting too high, let's cut your spending by 10%. He's talked about inflation rules, which tell you when you are or are not allowed to take that inflation adjustment. And then also he has rules about when you're going to turn that off. If you're getting far enough into retirement, maybe you can stop with the potential cuts to spending. That sort of framework, it can be harder to implement at a household level, but it's probably the most famous set of decision rules out there. And there's others. I don't know. Ratcheting rules, Michael Kitcey's developed those. The Vanguard talked about, it's kind of a floor and ceiling, but on percentage adjustments, which I think is a lot harder to think about than a floor and ceiling on dollar amounts.
So yeah, these are good. And I assume like a hybrid of these types of things is what you use in the real world. You're probably not like bringing the client in the meeting and being like, we're going to unleash the Guyton Klingler on you because they don't know what that is. And, I don't tell listeners, I didn't remember what that was. So, but in the real world, this idea of I'm going to adjust my withdrawals for what is actually on the playing field in front of me, what actually happens in the real world. I mean, that's the way you've got to do it. And like an extreme version of this, which people really can't do is, I'll just withdraw a percentage of whatever's in the account. So if I get cut in half in 2008, I'll withdraw 4% of that. That really limits or eliminates this risk. But in the real world, people really can't do that. So if you've got one extreme, I'm going to maintain my 4% no matter what. And the other, I'm just going to maintain 4% of whatever the balance is at any given time. There's a ton of stuff in the middle, and there's a lot of cool rules that have come up in terms of how to do that to maximize how long your money lasts.
The real world implications of this are so important because the thing you said right there at the end, it's like, I could demand my 4% a year, but then it's like, okay, 4% of what? 4% of that starting value, 4% of the value every December 31st, 4% divided by 12 of the value every single month. There's all these different ways we can start to like slice and dice what this means. In the real world, or in most of my client work, the experience we come across time and time again is you do a budget, and spoiler alert, most people don't have a budget or operate on a budget or whatever. Or it's all in their head. They're going by vibes. That's as close to a budget as they're going to get. Some people have 10 spreadsheets with 10 tabs. They map it all out. They crunch every single number down to the penny. They're in the minority.
You don't want to even guess who that might be, Matt, to you?
Both of us.
How about that?
Both of us.
It's embarrassing. So we'll move on.
But most of us budget on vibes, and so long as there's money left over, we feel okay about it, and we tell ourselves we're fine and we're doing the job. So the reality is when we're doing work with clients, it's kind of like, just show us what you're actually spending. Let's get a feel for what this looks like, if there's a surplus or a deficit, and then organize around that. The distribution strategies pretty much come down to, where do we have cushion and where don't we have cushion in life? So like, you got to pay for where you're going to live. You got to pay for what you're going to eat. You got to pay for insurances, some other basic stuff. What are those expenses? And then what's covering them? How much does Social Security cover? How much do the other fixed things? Maybe you have a pension, maybe you don't. How much do those things cover? And then we have to look at, how else do we backfill into that strategy? Maybe you have RMDs. Guess what? Your RMDs are variable. Like, there's all these things that start to wrinkle this up, and different ways we start to solve for, how much cushion do you need to feel comfortable so you can sleep at night versus how much do you not care? And that's the nuance of these variable withdrawal strategies, that they kind of truly are bespoke for everyone.
Yeah, and the real world is variable. It's not fixed. And that's why everything in like a financial plan or investing, I mean, it's got to be variable, because you're dealing with things you can't control and you don't know how they're going to play out. And so once they play, both your own personal spending as well as what the market's going to do. So once they do play out, it would make complete sense not to have some hard and fast rule, but to actually look at what that is and make decisions based on that.
Had a really funny real conversation that I'll amend just so they can't be identified in this. But this person has been fairly conservatively invested, structured, whatever else, for the last few years. And they've done that because there was a business sale. There was all sorts of other stuff going on. There was a lot of, we don't know how much longer this earnout will pay out. There's all sorts of stuff that was just hedge all the stuff, because it all started during COVID, which was really unsettling to begin with. And this person was on a trip, seeing some family members, and somebody was like, I can't believe how much money you have in cash or bonds or whatever the deal may be, because like, we're all the way invested, me and my wife, and we're earning like 20% a year. And it's like, am I doing something wrong? Did I do something wrong? Like, I don't feel like I did anything wrong, but did I do something wrong? Should I have gotten 20% a year? It's like, well, first off, they're not getting 20% a year. Wherever they got that number from, just like wipe that out of your head. And here's a quick perplexity search where
if they're doing it with something that's clearly going to, have massive risk in the future.
Yeah. And then it was walking back through, okay, let's go through the realities. Like, you were exiting this thing during COVID. The pandemic happened in the middle. Like, here's all the things we had to protect for. Here's all the things in the transition we didn't know. And here's all the reasons in your case why this still makes sense on paper. Has any of this stuff changed? And it was that realization of, this is what I intuited. Like, this was my feeling as I'm hearing 20% a year going, I don't think I want that. I mean, I want the upside. I want those results, but it doesn't, like, something was wrong in how to get there. And they recognize that. And it's really important to be able to unpack that nuance so that you can just intuit the correct decision for you and not just be chasing what the Joneses are proclaiming to get.
That's great though, because so many people don't recognize that, and it gets so many people into trouble. Like, so many people are focused on what is the return other people are getting, or what are the balances other people have. And like, none of that has anything to do with how much you're using your money to enjoy your life. Like, your life, if my SEP IRA balance was twice it was what it was right now, like, it's not going to matter. I'm not going to be a happier person today or tomorrow. It doesn't, it'll help me in retirement and all that stuff, but it's not like, I don't know. I think all of us tend to tie this too much into like our level of happiness. And then we take risks, or especially when other people are doing really well, we tend to do these things we shouldn't do in trying to reach this thing that might not even make us any more happier in the first place.
Exactly. And this, said it at the top, I'm going to say it again. This is the really important part about Wade Pfau's contribution to the financial planning literacy, is he takes that academic rigor out of the investment side and brings it right up to the line of where that emotional, intelligent identity story can start to happen. So it's like, here's all the math. Here's all the applications and all the fancy rules we can put around on different variable withdrawal rates and how to do them. And then right up to that line of where a person can interface with you and say, like, let's figure this out, and how you're psychologically wired to handle this.
So as we head in this next clip, it might be a good time to tell the listeners that you're going to be hosting a steak dinner at Ruth's Chris. Obviously, you'll be presenting
Ruth's Chris. It's way too nice of a place for a steak dinner to talk about.
Isn't that what they use for this stuff though? Don't they go high end, or maybe not? Is it like Outback or something?
My wife and I were out to dinner at some, like, just a local Italian spot, of which there's a million in our area. And there was definitely like a conference room being used in the back where two kind of like sweaty older guys, like in suits, came out a couple of times. And she was like, you can't like we're here having nice date night out or whatever. Like you can't go wander into that room. And I was like, I just need to know what they're selling.
What's going on?
I just need to know what it is. And I didn't. I was a good husband in this case, but I still play that back in my mind. This was not long ago.
And so the reason I bring it up, and it was obviously a joke, is that annuities do get a bad rap. I mean, obviously that kind of stuff goes on. People are having the steak dinners and selling annuities. They're a high fee to people that shouldn't have them. And so to some degree, there's some truth to that, but they do get a bad rap as a product because there actually are many places where annuities are an appropriate thing to do. And so Wade is actually a big, he's no one looked at the data more than he has. And he's a big proponent of annuities in certain situations. And someone like him wouldn't be if there wasn't some value. So here's Wade talking about annuities.
And annuities can be used lots of different ways. And so there's a lot of strategies that focus more on just getting tax deferral and so forth. I'm usually thinking about annuities from the perspective of retirement, which is to have lifetime income. And whether that's a simple kind of income annuity that's just, you pay a lump sum amount to get a protected guaranteed lifetime income for as long as you live. Or there's newer innovations, different types of deferred annuities, variable annuities, fixed index annuities that add living benefits. So they don't require you to annuitize the contract. You can still have access to the underlying funds. With a variable annuity, you can invest in sub-accounts and so forth. But then you add an optional living benefit that will support lifetime income. If your contract ever depletes because you got a bad sequence of returns or you end up living a long time, then that's when the annuitization kicks in and supports that lifetime income. And yeah, I think in the investments world, there tends to be like concern about annuities, and it's, I think, partly just comfort in the stock market. So I talk about there's three basic ways you could fund retirement, maybe to make this really elemental. You can use bonds. It's kind of a lot of people, they're not wanting to take risk and so forth. So bonds, CD ladders, you just have all your assets in bonds. And then you have two ways to spend, your principal and then any interest that those bonds earn. Now, that's not going to support a lot of income, especially in the low interest rate environment, and especially if you're worried you might live a long time. So there's two ways you can try to spend more than bonds. The first is the traditional investment approach, where you build that diversified investment portfolio. You use that high stock allocation, because remember back to the 4% rule, like 50 to 75% stocks in retirement. And then you rely on growth from the stock market as an additional spending source. And if you really believe in the stock market, you say that's all you need. Annuities, you don't need them. They're not giving you any value of safety because the stock market's going to be fine. But the other approach would look at the way you can spend more than bonds is through an annuity. And that's, you have the supported lifetime income. If it's a simple income annuity, you pay the premium, the insurance company puts that into their general account. It's mostly a fixed income portfolio. So part of your payouts are based on spending your principal, and any interest that the insurance company is counting is the payout rate they quote to you. But then you also get this mortality credit, the risk pooling. Those who don't live as long will help to subsidize payments to those who live longer. And so if you end up living a long time, a lot of your spending is covered by these mortality credits. And the idea that you don't get upside from the annuity, it's not true. It's like risk pooling versus the risk premium. You can spend more either by hoping that the stock market will outperform and support a higher spending level than bonds, or you can spend more because you used an annuity providing lifetime income, and then you receive these mortality credits from the risk pool to support a higher spending level. Now, if you end up not living as long, of course, in hindsight, you'd wish you didn't use the annuity. But given that you don't know that in advance, what the annuity can do is really allow you to spend at a higher level throughout retirement compared to bonds alone, because you get these mortality credits on top of the bonds. And then it's just a matter of deciding, do I want to be able to spend more than bonds by allocating to an annuity or by allocating to the stock market? What do I feel more comfortable with? And I think there's just, in that kind of I hate annuities and so should you type world, there's not an appreciation for the value of that risk pooling and mortality credit as a way to support a higher spending level that can be competitive with stocks and not really create underperformance relative to what you might have done with investments alone.
Yeah, well, as a quant, you can probably imagine this, but like the risk pooling thing is what I really like about this. And the idea that if basically if this risk is pooled together, And if I am somebody who, if I'm healthy and I'm running and, whatever, and I think, I mean, who knows, but I think I'm going to live longer, that's one place I can get a benefit from an annuity. Because if I outlive the average person in the annuity, I can get a benefit. And obviously just the safety of these annuities, I think we're going to talk a little bit later about a safety first approach, but like the safety of these annuities is really good too. So there's a situation where annuities can be very appropriate for the right person. There also are situations where annuities can be a ridiculous high fee product that's just paying someone a huge commission. You've got to be able to differentiate, and maybe you need somebody like you to do that. But I don't like that people just say like the whole thing, the whole industry of annuities is a bunch of garbage, because I don't think that's true.
No, it's definitely not true. And I can't tell you how many times we have conversations with people about, and usually it's around the SPIAs that Wade likes a lot, which are the single premium immediate annuities, and using them in the planning structure to basically hedge longevity risk, where it's like you have a pile of money, you don't want the piggy bank to run out of money. You just go, I want the piggy bank to just keep giving me this check. And in the event that I live beyond my lifetime, basically when the piggy bank would be zeroed out, could it just keep paying me? And that's a vehicle, that's a mechanism via risk pooling where you can buy an insurance product to get you beyond your lifetime, have a lifetime guaranteed stream of income. You got to read the fine print. There's lots of stuff that goes into it. But a lot of his work says if you can use this type of an annuity, an income annuity, to solve for this part of your puzzle, it can help you out. And very much agree with that. We get hired a lot by people who actually want to vet those options. And they're usually surprised too. We're like, no, you're going to go direct to the carrier. It's no different than like term life insurance to us. It's like, don't overpay for this thing. You're just paying for a piggy bank that's not going to run out of money, and you're transferring risk. Simple as that. There's lots of other products in the variable space and whatever else where people will get themselves into trouble. I always bring this up. I'm sure I've said it here before, but Jesse Livermore, you're not the Twitter personality, like the reminiscences of a stock operator. Do you remember his thing with annuities from the book? Does this ring a bell to you?
It's been so long since I read that thing, I don't.
In reality, Jesse Livermore, basically the person every trader quotes ad nauseum. He would make a ton of money and then he would lose a ton of money. And one of the things he realized when he got married and kids and all the other stuff leading up to his not so glorious suicide was he would make a ton of money and he'd go out and buy some annuities before he lost all the money again. Because it was like he recognized his own degenerate qualities and what he was going to go out and do. And the annuity was the insurance policy to make sure his family and his lifestyle and whatever else could be sustained. That's what you need to know.
Yeah, peace of mind is important for so many people, and it's important for everyone, really. So the idea that you have this thing that, you have a very high level of certainty in that makes you feel like you're going to be okay, like whether I can model the returns in my spreadsheet or whatever may not matter to you. Like just knowing that's there and being able to live your life, I think can be really important. And these can play a big role in that.
Yeah, especially in barbell strategies too, the Nassim Taleb concept. And I can't tell you how many people I've talked to in venture capital or other extremely high risk places that it's like the thing you need to counterbalance this, like at the end of the day, all you're telling me is that here's the odds that you're playing in this extremely risky game. Would you like to play these odds in this other extremely not so risky game, which is, I could make $1 bajillion or lose everything on this thing. It's like, okay, how about we just don't run out of money on this thing? And they go, yeah, that makes a lot of sense. Let's figure out how to pair this together so I don't have to give up the third house in Italy or whatever it is.
So this next step, I'm just gonna have you explain once we get through it, but here's Wade talking about RISA.
I talk positively about annuities. Well, some people hate annuities. I can talk positively about investments. Well, some people are very scared of, like, even though the stock market should perform well, they just can't accept investing in the stock market. Well, at the end of the day, people are just wired differently for this. And so the RISA, the Retirement Income Style Awareness, was an effort to try to help people understand as a starting point how they're comfortable building a retirement strategy. I think there's a lot to be said for incorporating insurance like annuities as part of retirement planning, but I've also heard enough people complain about that I recognize not everyone, it's not right for everyone. There are different viable approaches out there, whether it is a more purely investment-based approach, whether it is an approach that will build a floor of protected lifetime income, whether it's a time segmentation or bucketing approach where you just invest differently based on the time horizons for those investments. How do you help people pick a strategy? And that's what the RISA was all about. Alex and I looked at everything we could find talking about retirement, identified where trade-offs were being discussed, started writing questions about how people might evaluate those trade-offs. And we worked with a retirement researcher community, which is really a large kind of do-it-yourself online investing community at retirementresearcher.com. At one point, we were looking at 900 questions, and they're very helpful in editing those questions and then taking different preliminary versions. And ultimately, we got down to, at the end of the day, there's 2 primary factors and can be answered now with 12 questions. And it's just based on the statistical work. That's where I was saying I used to talk about probability-based versus safety first as schools of thought. Well, it's now just one of these factors. If you're probability-based, you're comfortable relying on the idea that the stock market will grow in a manner that you can rely upon to fund a higher level of spending in retirement. And there's no right answer here. If you're safety first, you may get the joke that, yeah, the stock market should do well, but you're fundamentally not comfortable relying on that when it comes to funding your essential spending in retirement. You'd rather have some sort of contractual protection behind that. The other, and that factor I could have guessed was going to be important. The other one that surprised me, but the data really just speaks to its importance, is this optionality versus commitment. If you're optionality oriented, you really value maximizing flexibility for all of your assets. It's like you don't want to lock in anything. You don't want to commit to anything. You just want to be able to make changes, respond to new situations. You really value optionality and flexibility. Some people are that way. Other people, though, have a commitment orientation. Now, the idea there is if you can find something that solves for your lifetime problem, you actually feel good about committing to it, taking it off your to-do list, even if it reduces some of your flexibility. We can also see there, people are worried about cognitive decline. And so they'd rather commit to something that will help them if they have trouble making financial decisions or that will help protect other family members. And so are you more commitment oriented or optionality oriented? And then the big aha was just based on those 2 factors, it explains all the different retirement approaches out there. And so that's the RISA matrix, the retirement income style awareness. If you're probability based and optionality oriented, that's a total return investing approach. Build a diversified portfolio and take a systematic distribution from it in retirement. If you're instead safety first and commitment oriented, that's really, before I start investing, I want to have a floor of protected lifetime income that may involve using a commercial annuity product. Then I have the foundation to invest on top of that for more discretionary goals. And those are the 2 core strategies that we see the most frequently. The other 2 are really behavioral strategies, and they evolve that way. So if you're safety first and optionality oriented, this is I want contractual protections, but I also want flexibility and optionality. I think that describes the bucketing approaches out there, or also time segmentation. The idea that, well, I get my protections by having short-term buckets and fixed income. I get my optionality and flexibility with the long-term buckets focused on growth and investment assets. And then the other behavioral approaches, I'm probability-based, comfortable relying on the market, but I'm commitment-oriented. And also when you're commitment-oriented, you tend to also worry more about outliving your money. And so I think behaviorally, that's this whole conversation around something like a variable annuity with a lifetime income benefit. The story there is you can invest for growth, but if markets don't do well, you have a protected lifetime income stream. That's probably going to be less than with a fixed annuity, but nonetheless, you have a protected lifetime income stream. So you get your probability-based side, but you also get you're committing to something that will help you manage your longevity risk. And we call that risk wrap. So everyone's going to have a retirement income style, and we really think that that's a great starting point for everyone as they transition towards retirement. You may not ultimately stick with the strategy that matches your style, or you may be income protection, but because of that, you have a job with a big pension. You don't need any annuities. You already have your income gap covered. So step 1 is just understanding your style. Then step 2 is working towards a financial plan and figuring out whether you need to take any action to help accommodate a strategy matching your style. But that's what the retirement income style awareness is really for me now, the step 1 of retirement planning. Understand your retirement income style. And that helps cut through all this debate about the extreme. Sometimes you'll see news articles saying retirees should be 100% stocks. Well, that's going to be an extremist type probability-based approach. Or you hear the infomercial about how fixed index annuities solve every problem under the sun. Well, is that appropriate for you? It may be if you have more of an income protection approach. It may not be if you have more of a total return approach. And I think this can just help people cut through all the debate and get to a good starting point for their strategy.
See, I'll just throw it to you because this is a great retirement framework. So I want you to you could probably do a better job than me explaining what this is.
So basically, think about this in terms of quadrants. That's effectively what he's giving us here. Safety first.
You know, I love quadrants, by the way.
I know you love a quadrant.
Like, oh yeah, if we get quadrants in there, like the economic, I just love quadrants.
Now, what's tricky about this one is, so the words make this one hard, but the framework itself is insanely useful. So let me just try to break this down here. So you got safety first versus probability based. That's one continuum. And I think about that as like everything is black and white versus everything is a probability distribution. That's the two ends of this continuum. So it's like black and white only. There's no gray areas to everything is gray on the other side of the continuum. The second line here is optionality orientation versus a commitment orientation. So everything has lots and lots of choices, and I want to preserve all those choices versus everything reduces to one choice. So now as I move around those quadrants, I basically get everything is black and white, lots of yeses and nos, but I want to still have lots of choices. Some people want that. To everything is a probability distribution, but I still want to have lots of choices. So that's this nice like mixed bag of all the worlds. Then everything is black and white. I want to reduce it all to one choice, and everything is a probability distribution with only one choice. So I wrote about this before. I'm cheating on this with some notes. What I would categorize as what Wade calls a safety first person who likes optionality. That's like you go to the casino and you have your maximum loss limit. So they go in, they go, I'm willing to risk $100, but as soon as I go bust, I'm out of here. That's a safety first person who likes optionality. Now, a safety first person who likes a commitment, they just don't go to the casino. They take their social security checks, they clip their coupons, they don't mess with messes. And that is a very enviable type of person. Now, a probability first person who likes optionality isn't just at the casino to play one game. They're going to jump around and feeling at the moment. They still might have rules, but they're the secret agent who knows where the exits are and who the sexiest person in the room is, but they're going to stay fluid in every single one of those choices. And a probability first person who likes commitment, they're going to play the odds in the casino, but only on one game. So that's the guy who goes in and says, I do high limit, poker, or I do roulette, and I do nothing else with my pre-planned tax loss. You can take that, and again, I'm not crazy about the words, but understanding that people are oriented into one of those four quadrants typically in their behavior can help guide a lot of the decisions. Did I totally lose you in that, Jack, or my?
No, you actually were very good. It always comes back to the gambling with us. I don't know why we're always in the gambling.
Well, we love to compare Wall Street to the casino that it is, right? It's just nothing but high flying gambling and.
I was just happy you didn't go with the scratchy lottos because you probably could have used the entire framework around how you play the scratchy lottos. I guess the commitment safety first person is not playing the scratchy lottos in the first place. But
this is good. This is good that you remember the scratchy lottos details. And yeah, we're sticking with the casino on this one though.
So this last one is just his answer to the closing question. And I think this is really good because we get trapped in numbers and rules and probabilities and all this stuff, but I think it's important to understand what all this means. So here's Wade answering the question. If you could teach one lesson to the average investor, what would it be?
I'd say to be flexible and also to enjoy life for sure. So I do, in kind of this whole 4% rule debate, I do tend to get associated with 4% is high, and therefore you've got to be more conservative about your approach to retirement. But being flexible, being able to go with the flow. I mean, people at the end of the day might be okay if they don't have much more than a Social Security benefit. And it just makes sure you're not overly saving or not accounting for the fact that spending may decline with age. And so to strike the right balance between enjoying the present, but also being responsible about protecting the future as well, and to not get too carried away in either direction.
I think it's great to see somebody who's a retirement researcher, who's doing tons of detailed stuff, ultimately say, enjoy your life. And as much as he's been this person who said, the 4% rule may not be enough for some people, like he's not saying like, let the 4% rule dominate what you're doing in your life. Like if you're withdrawing 4.2%, or if you don't think the 4% rule is going to hold, you should be in a complete panic. And it's like, what we're doing this for is to enjoy our lives. And so I think it's important, like anything we talk about in this podcast, and this stuff specifically, is to realize like all this can be very helpful. These frameworks can be great, the probability stuff, the sequence risk. But at the end of the day, we are here to enjoy our lives and not get trapped in this.
Wade wants the role of the advisor, the role of the client, the person with the money to ask these questions, wants to take you all the way up to that line of them being able to ask why. What was this for? What's the reason I did this? He wants to give you all the data to come right up to that line of go, okay, now you have to actually go talk about this like a person. Here's all the different frameworks. Here's all the different orientations, but now you have to talk about why you were doing this. Why does this matter to you? We've talked about this before too. The intentional investor interviews that I do, yes, it's about the money. It's about the financial capital. Everybody's interested in that stuff. But when it boils down to it, we have to understand the human capital. Like, what did you do for work? Why was that a good trade-off of your time? Why did you enjoy trading your time and your life in your younger years for whatever it is that you were getting into, even when it fails? We talk about the intellectual capital. What's the stuff that you've created, the stuff you wrote down, the things you've recorded, whether it's the books, the articles, the podcasts, whatever, what intellectual capital have you contributed? We talk about your social capital. So the people around you, your friends, your family, how did you make surpluses in those categories? And we talk about your wisdom, which could be the ideas that'll transcend beyond your lifetime to those friends and family, to maybe kids or grandkids or whatever else. Those are all the whys. A life well lived is figuring out those categories and where you're going to have surpluses in each. Wade's work takes us right up to that line with the academic data on solving for the numbers and says, please go care about this last thing. His answer to the closing question is that reminder. He does this in his personal life too, which I really admire about him the most.
Yeah, that's great. And I've had to walk clients back from this a lot. Like clients who are worried about, well, I have this specific withdrawal rate or this specific thing going on. And yeah, I mean, we want to be concerned about that if someone has too high a withdrawal rate or something like that, but we also don't want to let it dominate their entire lives. I mean, there's things that can be done to manage these things. That's part of our job here. When it takes over your whole life and you get wrapped up in all this stuff, it only has negative consequences, I think.
Yeah. You got to remember what you're doing it for ultimately and why that matters to you. And there's an intrinsic worth, call it what you will. There's an intrinsic worth to these things, to these activities. It's more important than the money. The money's always going to be there. It's just a reality of the situation. But
and just before we wrap up, I would recommend your intentional investor, Chris Abdulmasih, on the most recent one is really, really good. It's on the Epsilon Theory YouTube channel. Like a really good story of somebody who kind of came through the options world and has done, I think he's done basically everything you could do in that space. It's an awesome story for anybody who's interested.
Yeah. And if you're interested in choice architecture and as it leads you through these things, I think Chris is an embodiment of a lot of the type of stuff that we saw here in this Wade Pfau interview too.
All right. That's a good note to wrap up on. Thank you everybody for joining us and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.